the concept relating to income from capital gain, where we will explore the chargeability provision, computation aspects, and different exemptions available under this head.
When we talk about income from capital gain, it means any profit or gain arising from the transfer of any capital asset affected during the previous year shall be chargeable to income tax under the head capital gain only. Here, different concepts are involved under this chapter. In fact, we can say the definition itself explains different concepts like capital assets. Here, capital asset means property of any kind, whether held by an SSC and that is connected with his business or not, that is irrelevant. Further, capital asset means any security held by a foreign institutional investor which has invested in such securities in accordance with the provisions of the SEBI Act 1992. But there are certain exceptions of the capital assets. Under the provision of capital gain, capital asset does not include any stock in trade, consumable stores, any raw material, and that inventory is held for the purpose of business or profession. Personal effects like movable property or wearing apparel. Such personal effects is used by the SSC or any member of households. However, following assets are not treated as a personal effects like any jewelry, drawing, painting, sculptures, and work of any art. Apart from this, capital asset does not include any rural agricultural land in India. We can say any urban land that has to be treated as a capital asset. But when we talk about rural agricultural land that is situated behind 8 km from the local limits of the municipality or where population does not exceed beyond 10,000, that area is called as a rural agricultural land in India. Next, we can discuss about the concept relating to transfer. Here, under capital asset as well as under capital gain, transfer means sell, exchange or relinquishment of the rights of the asset. Transfer means the extinguishment of any rights therein, like when an investor invests in share capital and due to default in payment of any call money or application money, that share is forfeited by the company in the name of shares forfeited. Such forfeiture is called extinguishment of right of the shareholders. So that is a transfer. Further, transfer means the compulsory acquisition under any law. The concept can be understood when Metro extends its proposal for construction of metro in Delhi like Connaught Place and Barakhamba. Several buildings were compulsorily acquired by the government. That compulsory acquisition is also a transfer. Next, transfer means conversion or treatment where the asset is converted into or is treated by him as a stock in trade of a business. That is a transfer. Further, the maturity or redemption of a zero coupon bond, that is also a transfer. And any transactions that provide a partial right relating to any immovable property, that is also a transfer. Whether you have received the possession or not, if you have transferred the amount, you have got the keys and registration process is still on. Still, it is a transfer. Now, capital asset has been divided into two parts, that is short-term capital asset and long-term capital asset. Any gain arising on short-term capital asset is called as short-term capital gain. Any capital asset held by an SSC for not more than 36 months immediately preceding the date of its transfer is known as short-term capital asset. Further, any shares, any instruments, any stock market mutual fund, if such assets are transferred, then holding cannot exceed beyond 12 months. Furthermore, where transfer is relating to any immovable property, any residential house or plot, here the holding cannot exceed beyond 24 months. So any capital assets where holding does not exceed beyond 12 months or 24 months or 26 months, the gain arising on such transfer will be called as a short-term capital gain. When we talk about long-term capital asset, the holding, if exceeding beyond 36 months, it will be called as a long-term capital asset, and gain arising on such long-term capital asset will be called as a long-term capital gain. Here, the tenure of security or share will be exceeding 12 months, and tenure for residential house property and plot shall be 24 months. So any holding exceeding 12 months or 24 months or 26 months, it will be called as a long-term capital asset. When we talk about the computational aspect, here under short-term capital gain, we have to show the full value of sale consideration as a sale price. Out of sale consideration, a deduction is allowed in the name of expense on transfer, like stamp duty, registration charge, brokerage, and so on. These all expenses are allowed out of sale consideration. Then resultant figure is net sale consideration. Out of sale consideration, we will deduct cost of acquisition of the house property or the capital asset. Further, if any improvement has been done in relation with the capital asset, such cost of improvement shall also become the part of deduction. Now, the resultant figure is either short-term capital gain or short-term capital loss. Now, when we discuss about the computational aspects of long-term capital asset, here the same format applies, but the only difference is that the cost of acquisition as well as cost of improvement has to be indexed. Now, a question arises, what do you mean by the indexation? Here, indexation means to identify the correct and actual value as on the date. When someone has purchased any property in the year 2000 or 2005 or 2010, then we have to identify the actual and current market value as on the date. In that relation, government releases every year an index number that is called CII, that is Cost Inflation Index. Such index number has to be multiplied and divided with the cost of the acquisition and cost of improvement. With such multiplication and division, we can arrive at the value of the fair market value as on the date. Such indexed cost of acquisition or indexed cost of improvement has to be deducted from the net sale consideration, and resultant figure will be called long-term capital gain or long-term capital loss. The tax rate for short-term capital gain is 15% if it relates to shares or stock instruments. When short-term capital gain relates to other capital asset, it will be chargeable at the normal slab rates. When we talk about long-term capital gain, it is chargeable at the rate of 20%, that is the fixed rate. But when long-term capital gain arise on the shares or market instruments, it is exempt if value does not exceed beyond rupees 1 lakh. If value exceeds beyond 1 lakh, then it is chargeable at the rate of 10%.
So today we have learned about the concept relating to income from capital gain, where we explored different exemptions, different computational aspects, and chargeability concept. In the next session, we will explore more about different aspects of income. Keep learning, keep growing. See you next time.